The top stories live from the Sky News City studio. Turning a crisis into an opportunity, Joe Biden's $4 trillion economic plan.
After just 100 days, I can report to the nation, America is on the move again.
Also ahead, the winners. Facebook and Apple double their profits during the pandemic. And the losers. Heathrow Airport says it's lost nearly £2.4 billion. Plus, making pet food sustainable. We'll speak to the company that wants to feed your dog insects. Good morning, this is Ian King Live, an hour of business and economic news from the heart of the city. US President Joe Biden has set out what he calls a once-in-a-generation spending plan worth $4 trillion. Some analysts see the proposals as the biggest overhaul of benefits for American families since the 1960s. Well, last night's address to Congress laid out the second part of the president's push to build back from the pandemic following the infrastructure and jobs package announced last month. Well, the proposals include universal preschool for 3- and 4-year-olds, 2 years of free community college and expanded access to childcare. And the president said that he would ask companies and the wealthiest Americans to pay what he called their fair share. That's a euphemism for tax increases.
100 days since I took the oath of office and lifted my hand off our family Bible and inherited a nation, we all did, that was in crisis. The worst pandemic in a century, the worst economic crisis since the Great Depression, the worst attack on our democracy since the Civil War. Now, after just 100 days, I can report to the nation, America is on the move again.
Well, joining me now is Joe Sternberg. He's on the editorial board of the Wall Street Journal here in London. Joe, welcome to you. Now, this comes on top of $1.9 trillion worth of COVID stimulus, another $2.3 trillion in infrastructure spending. I mean, America hasn't seen an expansion of the state like this since Roosevelt, has it?
Yeah, that's absolutely right. And, you have to understand the political ambition here, because I think that there was definitely a lot of receptiveness to emergency relief when we were in the depth of the pandemic, but we're past that point now. I think the vaccination program has worked very well. Economies are reopening. The economy in America already is returning to a growth path. And so now I think the political gambit is to push ahead with some of these more left-wing policy priorities that the Democrats want to do during this period when they control both the White House and both chambers of Congress.
I mean, Biden stressed during his speech last night the need to compete more effectively with China. Was that a way of packaging all this extra spending to try and get people on board who might otherwise be suspicious of it?
Yes, I think that's going to be part of the political hope, but it won't necessarily work because it's pretty hard to conceal the fact that a lot of this is actually an expansion of social spending. I mean, sort of the infrastructure, the roads, bridges, airports, tunnels, the sort of thing that actually affects America's competitiveness is a very small fraction of the total dollar amounts that we're talking about here. The rest of it is an expansion of various forms of social welfare spending, and also expanding a lot of those benefits into the middle class or the working class in America in ways that we haven't historically had. And I don't think there's any way to make that less controversial than it's going to be over the next couple months.
Joe, does this go over and above what Biden and Harris were talking about during the election campaign last year?
Well, there were hints that they were going to be doing programs like this, and it was certainly clear that this is something that the progressive left of the Democratic Party has wanted to do for a long time. Their political challenge is going to be whether this is what voters actually thought that they were voting for. And this is a challenge of the fact that they really ran as the anti-Trump ticket without talking an awful lot about a policy platform and presenting themselves as a moderate alternative. And I think that's going to complicate the politics of selling this package in the weeks and months to come.
Well, you mentioned the job that they have in selling this package. I mean, clearly higher taxes are on the agenda. He's going to need some Republican support to get these measures through, isn't he? Never mind that, some moderate Democrats.
Yeah, well, the moderate Democrats are going to be the key here because, in theory, they can use parliamentary tactics in Congress to get some of this stuff through on a party line vote. But again, you have a lot of Democrats in moderate states or in moderate districts who are going to have to face their voters in 2022, so about 17 months from now, who are going to be worried about whether this is the kind of thing that those voters voted for, and especially because there's already debate about how the corporate tax increases Biden has proposed might negatively affect the economy or American competitiveness. And we haven't even gotten to the personal tax increases yet. I don't think they can confine this only to the quote-unquote rich, the way Biden promised last night. There's just not enough money there. So inevitably, they're going to have to reach into lower income brackets to increase the taxes, and that's going to be very politically challenging.
And Joe, one of the things that a lot of Democrats want in return for supporting these packages is a reform of SALT. So you better explain what that is to the uninitiated.
Yeah, it's a complex quirk of America's federal government where you have both the federal government in Washington and then the state level and local governments that can impose their own taxes. And before 2017, taxpayers who lived in high tax states like California or New York were actually able to deduct most of their state tax payments from their federal tax return. And of course, the 2017 tax reform limited that, and that essentially reduces a federal subsidy for high tax governments that tend to be run by Democratic governors and legislatures. So there's going to be a big push to try to restore that as a backdoor way of subsidizing some of these Democrat-run states, but that comes at the cost of federal revenue that they would need in Washington to pay for this. And so I think the politics of that are going to be very complicated, especially for moderate Democrats in the House who represent some of these districts in lower tax states where taxpayers will wonder why, on top of all of the other tax bills that they're going to be asked to pay, they're also being able to, they're being asked to subsidize people in New York or California or some of these higher tax areas.
Joe, in a word, is Biden going to be able to get this through Congress?
I will be kind of surprised if he can get all of it through in its current form. I think that especially because the Democratic majority in the House is so narrow, they're really going to have to thread the needle with some of these moderates. And so I think that, a lot of it probably will get through. A lot of the tax increases will go through in some form. But I don't think what we heard last night is the last word.
All right, Joe, thanks for that. We'll be seeing you later on in the programme for the paper review. So see you in a bit. Thank you.
Bye.
Now, Britain's busiest airport isn't very busy. Heathrow Airport has announced losses of £329 million in the first 3 months of the year, with passenger numbers down 91% on the same period last year. Well, joining me now is Heathrow's Chief Executive, John Holland-Kaye. John, welcome to you. This brings your total losses since the start of the pandemic to £2.4 billion. For just how much longer can you wear these kind of losses?
Well, we're well funded. We have 40% more cash in the bank than we had this time last year. That'll keep us going at least for 15 months, even if we don't have a single passenger travelling through. So we're in a good position. And the question is when the international travel returns and how quickly it can return. And that's entirely in the hands of the government and the policies they set to reopen international travel. So we're focused on May the 17th. We're getting ready to open up then, working with the airlines to make sure we can give a really warm welcome to passengers. The key question is whether Border Force will be ready to receive those passengers when they come back into the country so that they have a smooth journey through the airport and not the kind of lengthy queues that unfortunately we've seen too often in recent weeks.
Absolutely. And is Border Force, do you think, going to be up to dealing with an upsurge in passenger numbers if that happens after the 17th?
Well, I'm deeply concerned about that. They're struggling to cope with even the few thousands of passengers who are coming in at the moment and all the extra checks that Border Force have to impose on them. Every single passenger coming in has all their paperwork checked before they get on the plane and then checked again at the border by a qualified Border Force officer before they're allowed into the country. And they either need to change that system or they need to have more Border Force officers on the desks. And when we have the longest queues, it's when there's only a couple of people staffing the desks. Now, that's just bad organisation. And I think Border Force and the Home Office need to get a grip on this ahead of May the 17th so that immigration does not become a stranglehold on the UK economic recovery.
I imagine you've raised this with the Home Office, John. What have you had back from them?
We have raised this with the Home Office. We're getting good support from other parts of government, particularly Department for Health and DFT, but we're not getting enough engagement yet from the Home Office, who actually own this problem. And so that's something that needs to be addressed quickly. In time, of course, all of this will be automated so that you can just scan your passport and all of the information will come together and you'll be able to use the e-gate as normal. But that won't be in place fully until after the summer. And so this is going to be an issue for all passengers coming into any UK port before then. So it's important that Border Force really steps up and makes this work. And the impact, if they don't, is that we'll see controls over flights coming in. And both Heathrow and other UK airports have turned away flights in recent weeks because of congestion in immigration. And if they can't cope at these tiny volumes, how are they going to cope after May the 17th? They need to stand up, get a grip of this, and make sure that we can give a really warm welcome to all those passengers coming into the UK in a few weeks' time.
John, how bad could this be, though, if Border Force doesn't raise it game? I mean, potentially, could you have to be turning away flights?
Well, we have done that already. We turned away some flights from India a couple of weeks ago because of concerns that Border Force would be able to cope. But at worst, if we get significant congestion, and just to give you a sense, a single A380 coming in with 500 passengers creates a queue 1 kilometre long. So if there's only 2 people on the border, then that very quickly gums up the entire airport. We have to keep any further planes arriving, keep the passengers on the plane until the queue has cleared. And if that gets too congested, we have to divert planes to other airports in the EU. Now, that is a disaster for anyone travelling and should be an embarrassment for the UK government that this is how we manage our border. It's easy to fix. Border Force have far more than 2 people to man the desks. They just need to get organised and make sure they're properly staffed.
So, John, to pick up on that point, if you do turn away a flight like you did with that one from India, where do they end up disembarking? Is it somewhere like Paris?
Well, the India flights, we just didn't allow them to come in at all. So those passengers will have either not travelled at all or will have come in through another airport. But if we get into diversions, particularly at the moment where not all airports in the UK can accept passengers from all destinations, then yes, we may be diverting flights coming into Heathrow, into Charles de Gaulle or to Frankfurt or somewhere else instead, which is a terrible journey for passengers and is completely avoidable if Home Office steps up and gets a grip of Border Force.
It absolutely is. I mean, to what extent, though, have you contributed to this? At the moment, Terminals 3 and 4 are closed. How quickly can you get them out of mothballs?
Well, Terminal 3, we're getting ready to open. We'll open it when the demand is there. I actually walked around it yesterday. It's looking fantastic, probably better than it was before we closed it because we've had the time to do a deep clean. We're getting the shops open, the restaurants. We're working closely with the airlines so we can give a really fantastic welcome to people when they come in. And it's a really exciting place at the moment. We've all been very quiet for the last 12 months. Now there's a bit of a buzz about the place as people are looking forward to getting back to business. But it all depends upon the government restarting on May the 17th. And you'll have seen that we've reduced our forecasts for the year. We had been expecting 37 million passengers this year. That's the forecast we put together in December when the market was opening up again. Now we think it could be anywhere between 36 and just 13 million passengers. And we know the demand is there. Lots of people want to fly to see their businesses or customers, visit their loved ones. It's all a question of when and how the government will open our borders again.
Now, separately, John, earlier this week, the Civil Aviation Authority said that you could pass on some £300 million worth of COVID costs to the airlines in higher landing charges. You were looking for £2.6 billion. Where does this leave you financially?
Well, this is only the end of the first half. The CAA has said that they will look at this in the round as part of our next regulatory settlement at the end of this year. And just to remind you, we are economically regulated. There's a cap on our charges, but investors are encouraged to invest in the airport in return for a limited upside and limited downside. And that's allowed us to invest £12 billion to create this fantastic world-class asset that passengers love and airlines love. They make higher margins at Heathrow than any other airport in the world. We give them their slots for free, and they can sell them for up to $75 million. But all of that asset has to be paid for. And while regulation protects the airlines in the good times so that we don't put our prices up, it also has to protect the airport in the bad times so that we can still fund this amazing asset at Heathrow. And that's what we're asking the CAA to fix. They've given us £300 million now. They can still address the rest of the money that we're looking for as part of the next regulatory settlement.
John, I read the CAA statement as a broad hint that your shareholders ought to put up more capital. Do you think they're in the mood to do that?
Well, shareholders have already put money into the business. They've foregone dividends, which is the same as putting in equity, and they won't be taking dividends for some time. And of course, that's hugely important to pension funds like USS, the British Universities Pension Fund. They rely on those dividends to pay their pensions. So that's a big give by shareholders. We've also put equity into our regulated business. So we've very much done all the right things to protect the business. We've raised funds. We have £4.7 billion of cash in the bank that will see us through this terrible crisis and gives us confidence that we will recover. But ultimately, investors have to be incentivized to put money into regulated assets like Heathrow. And if they have unlimited downside and only limited upside, that's not a good bet for any investor, and no pension fund will put money into a business like that. And it's up to the regulator to make that good.
All right, John, we have to leave it there. Good to talk to you this morning. Thanks for joining me. Well, Heathrow was one of a number of companies publishing results this morning. Let me take you through some of them. NatWest has reported a return to profits after becoming the latest bank to release some of the provisions set aside last year to cover potential bad debts. The bank, which remains 59.8% owned by the taxpayer, reported a pre-tax profit of £620 million for the 3 months to the end of March. That was up from a loss of £109 million in the 3 months to the end of December, and also up on the same quarter a year ago. Alison Rose, the chief executive, said defaults remained low as a result of government support schemes and said there were reasons for optimism with the vaccine programmes progressing at pace. Royal Dutch Shell is raising its quarterly dividend to shareholders after reporting a 13% rise in earnings to $3.2 billion during the first 3 months of the year. Well, the better-than-expected figures reflect higher oil and gas prices and asset sales, and would have been better still were it not for a $200 million hit inflicted by the winter storms that battered Texas in February. The dividend increase is significant because at the height of the pandemic last year, when the oil price crashed, Shell actually cut its payout to investors for only the first time since the Second World War. Unilever, the food and household goods giant behind Knorr Soup, Dove Soap and Magnum Ice Cream, said sales during the first 3 months of the year were up 5.7% on the same period last year. Alan Jope, the chief executive, said this was partly due to some price increases, but mainly reflected a rising consumption of ice cream in the home, continued strong sales of Domestos bleach, and a rise in demand for prestige beauty products. Now, to the company planning to build Europe's largest battery factory in northern Italy. The first phase of the new plant isn't scheduled for completion until 2024, but it has ambitions to employ 4,000 workers supplying the electric vehicle industry. Well, joining me now is the founder and chief executive of Italvolt, Lars Karlstrom. Lars, very good morning to you. Why have you chosen this particular location?
Good morning. Good morning. Well, this site is very amazing in a way because the historical site is the former site of the Olivetti, and it once was a very prosperous area of northern Italy, which actually accommodate up to 5,000 workers. We are now able to replicate this and restoring this society and bring it back to where it once was, and giving the opportunity for new jobs, and also adding on supply chain, which can add on another 8,000 to 10,000 jobs easily. And that's actually the opportunity that the new green industrialization gives us. And that's something that also President Draghi now have announced actually with the recovery fund, and will give an amazing opportunity for Italy to be once again a prospering economy. I foresee in the next 7-8 years that we are seeing Italy as one of the leading countries in Europe when it comes to new green industrialization. And as we have a very skilled workforce in Italy, we have many small companies today, which are ready to ramp up their production to support a new green supply chain. I foresee that yes.
Give me an idea of how much this is going to cost to open this factory.
Yes, we are. We are talking about numbers around 3.5 billion euros. And this will produce batteries for around 550,000 cars, which is on a market where you actually in Europe today produce 18.6 million cars. Of course, not all of them are electric, but let's say 2030 that we have 60-70% of these cars are electric, which means that this is a relatively small contribution that we're giving to the European market. So therefore, we need to build a lot of these factories. And I foresee also in Italy that we're going to have at least 2 or 3 of these factories here in the next 5 to 8 years.
Some people would say, hang on, isn't it just cheaper to import car batteries from other parts of the world? Why is it so important that Europe has its own domestic car battery manufacturing facility?
The importance is that we need to address the supply chain and certify the supply chain. We cannot firstly transport batteries from far away. They're very heavy and add on more pollution on the environment. So from that perspective, we need to produce the batteries close to where they're about to be used. And we have a significant car industry in Southern Europe. Also, the supply chain is very unclear in many areas of, for instance, like Asia. And we need to be able to certify the supply chain to make sure it's green. Otherwise, these batteries that we are seeing here coming from far away are many times dirty batteries. We will certify all supply chain, our production methods, and all our products that will be used for producing this battery. It's a very important part that something has to be addressed from central government, from European Union, that we are make sure that this is not a dirty battery that we are now having in the cars being produced in Europe. So that therefore is the essence.
Now, you, of course, set up British Volt in this country. You had to step aside from that in December last year after it emerged that you had a tax conviction in Sweden from 2 decades ago. Do you feel you were unfairly treated?
First of all, it's a 25-year, very small offence at the time, which was, the advice we had was that we shouldn't create any more buzz around those things. And I had already plans for moving over to Italy. So I think the situation was better for me as to move on and don't continuing with that kind of, what should I say, public dynamics in media, which was totally, ridiculous in a way. But anyway, my plan was still to be in Italy, and I continue being in Italy. So it came very handy. So I actually sold my shares in British Volt, and I have been able to reinvest these funds in Italy, which is a very good move.
So Britain's loss is Italy's gain then?
Yeah, well, I must say that the support we have received in Italy has been amazingly good. It's a fantastic opportunity. People are extremely supportive and welcoming this project in an amazing way, which I couldn't foresee really. It's a great enthusiasm, and the dynamics and the energy that we see in Italy today is beyond my wildest expectations.
All right, Lars Carlstrom, very good to talk to you this morning. Hope to see you again soon. Thank you.
Thank you.
Well, still to come here on Ian King Live. We'll be talking about how Facebook and Apple have doubled their profits during the pandemic. Don't go away. Welcome back. Well, joining me now is the Chief Strategist at Natixis, Esti Dweck, and Neil Wilson. He's Chief Market Analyst at Markets.com. Welcome to you both. Esti, let me start with you. I mean, we really did see some blowout numbers last night from Facebook and Apple, didn't we?
Absolutely. We saw very strong earnings results from both companies. We've seen generally good results for technology stocks in the last few days. One more to come tonight after the close. But from the stock reaction, we can see that markets were really expecting these blowout numbers. They were expecting earnings to top estimates. And so the expectations are really quite high because this reopening is already to some extent priced in.
SD, I mean, markets always typically look ahead some 6 months' time. I mean, what's next for these companies? They surely cannot carry on delivering profits growth of this order.
That is going to be the big question. I think maybe we won't see beats to the same scale. In some cases, we didn't have as much guidance, which allows the beat to be even bigger. But generally speaking, if I'm thinking medium to long term, I do think that the sustainability of the earnings growth of the technology sector is going to stay, and it's going to continue to appeal to investors.
Well, Neil, let me bring you in. We heard today from NatWest. I mean, the results on the face of it weren't too bad, but the share price is off.
Yeah, I mean, another sort of good banking result, really. I think the shares are maybe off just because of a slight miss on the total income number. Came in at 2.66 billion. I think they were expecting 2.7 billion. So that might be one of the factors there. I think quite encouraging seeing the sort of outlook for the rest of the year, and encouraging to see these sort of reductions in the credit impairment provisions. So all that money that banks had set aside for bad loans that they expected last year, about 12 months ago, because of the pandemic, they're able to reduce that amount because of all the government support that's meant that businesses haven't gone out of business and people have not been losing their jobs to the extent that we feared a year ago.
Neil, we also heard today from Unilever. I mean, this is a bit of a theme developing here. All of the consumer goods companies have been doing really well lately. I think Nestle last week recorded their best quarter for 10 years. Is this all pandemic driven? I mean, this isn't a sort of going to be a permanent feature of the market from here, is it?
Well, I think, I mean, I think the consumer goods companies, they're enjoying a bounce on the reopening. You're starting to see with Unilever some of the out-of-home goods doing better. As, the US in particular and Asia reopen and people are out in restaurants again and so on. So that sort of boost that I guess you get from a degree of pent-up demand is a factor. You are seeing a bit of pricing pressures coming in as well. I think that's something that we need to watch. That's been a feature of the entire earnings season, both US and in Europe, is corporates really signalling that raw material costs are rising, commodity prices are higher, freight costs are higher. So that would be one to watch. And I think Unilever did warn that margins might compress a bit in the first half of the year before picking up again. So it's a bit of an unusual quarter or two that we've got for a lot of these companies as they're reporting big recoveries from last year and enjoying this pent-up demand getting released. So it's not necessarily that we're going to see this level of growth, say, a year from now.
Now, Esti, we've also heard from two of the super majors in Europe today, Royal Dutch Shell in this country and Total in France. I mean, again, it's been a big theme this week. The oil companies are all doing pretty well.
Yes, we're seeing a reopening of the global economy, an improvement in global trade that is set to accelerate over the coming months. There were some questions with the situation in India and the spike in cases there and how much of an impact that could have on oil demand for the year and for the coming quarters in particular. It appears, it's maybe a bit early, but it appears that cases may be reaching something of a peak over there. And of course, vaccination is improving in Europe. That is set to accelerate further throughout this quarter. The US is doing very well. We talked about inventories earlier. As these cases roll over, as vaccination improves, this reopening trade is going to gather steam again, and oil prices should continue to move higher. Now, supply remains relatively abundant, but for now, I think it's more about reopening.
Briefly, Esti, to pick up on the point that Neil made just now about inflation, and we've got obviously higher oil prices as well. How quickly does that start to cause tremors in the bond markets?
Well, we've seen a big reaction already if we think back to last August where we were and how high we've come. But what is important, I think, for the bond market is more what central banks are looking at and what they're saying. And the Fed's been very clear it is not ready to remove any stimulus yet. And it really views these inflationary pressures as transitory. So commodity prices are higher. They don't usually factor into the core aspect. A lot of these supply chain bottlenecks should gradually improve in the second half of the year, and that's the Fed's expectation. So I think we've probably seen the big bulk of the move in terms of yields. Now, can we move a bit higher on this reopening reflation trade in the coming months? Absolutely. But I do think we probably retreat a little bit later in the year, because so much of the good news and this reflation and this reopening and the fiscal spending is probably already priced in.
All right, Esty, Neil, we have to leave it there. Very good to see you both this morning. Thank you for joining me. Well, still to come here in Ian King Live, we'll be speaking to the chief executive of the courier company Yodel about how they're helping to meet the growing demand for home deliveries. Stay tuned. Welcome back. Now, one of the themes of today's programme has been the winners and the losers from the pandemic. Over the past year, we've all done a lot more shopping online, and it's been a boom time for courier companies. Well, Yodel is heading for its first annual profit since it launched a decade ago. And joining me now, Yodel's chief executive, Mike Hancock. Mike, welcome to you. You're clearly seeing astonishing volume growth right now. I mean, surely it can't continue at this kind of level.
Yeah, good morning, Ian. Thank you for having me on the programme. We're announcing a very strong set of results this week. Our third quarter has seen volumes 59% up year on year, which is very strong. We do believe that the volume strength will continue, though. We've seen across our portfolio of retail partners through the pandemic, some categories growing, some categories not doing so well. But overall, there's been a net benefit, and a number of new people have entered the e-commerce market, and they've enjoyed the experience. And we think the volumes are here to stay. And as a consequence, as we look forward now, we're making significant investments to increase our capacity to be able to cope with what we believe will be further growth in the parcel delivery market.
Yeah, you took on some 3,000 people in November and December. What sort of hiring plans have you got this year?
Yeah, you're right, 3,000 people before Christmas. Many of those were to cope with the seasonal peak around Black Friday and Christmas. I'm pleased to say more than half of those 3,000 people are still with us. The volumes have been so strong after Christmas. We're announcing plans this week also to look for a further 700 new colleagues across a range of different types of work. 200 of those will be drivers, but also many people to work in our parcel sortation hubs.
And when you take these people on, Mike, are they contractors or are they employees? You're not going to fall foul of this Uber court ruling or anything like that?
No, the people I'm talking about here will be employed people. The Uber case is a very different situation to the Yodel employees. And yeah, we're looking for permanent staff.
Now, you mentioned just now the categories. You're seeing different growth from category to category. Which are the ones growing strongly? I know you did a lot of food and drink last year.
Yeah, food and drink were particularly strong. But over and above that, pet food was incredibly strong for us. We hear lots of stories about people taking pets on for the first time through the pandemic, because they're at home to look after them. They clearly need the food delivery products, and we're very strong in that sector. We've also been very, very strong in flowers, and I think we've been a beneficiary of the fact that as people have not been able to travel and see friends and relatives, perhaps they've thought about sending them flowers, and we've certainly seen good growth in the flower market.
Stay tuned, because we've got an item on pet food coming up later in the programme. But look, Mike, what about the road closures that are going? I mean, particularly here in London, councils are shutting roads left, right and centre in the name of making the air cleaner. Is that creating a lot of hassle for your drivers?
Yeah, I mean, there are problems every day in the delivery world. Sometimes it's road closures, sometimes it's road accidents. We have robust plans to cope with these, and we know about many of them in advance, and we plan accordingly.
I gather you did some research recently suggesting that customers are actually rewarding those delivery firms that are greener. Have you got much evidence to show for that?
I don't think we have any evidence to suggest that's the case at the moment. I think, what we're certainly seeing is that customers value their delivery companies on the basis of a couple of things. I think, firstly, it's the quality of the service, and it's the way we keep the customers updated on the parcel journey. There's a lot of emotion around parcel journeys once people have ordered their products, and customers really do. They like to be kept informed about where the parcel is at different stages, and if there are problems with the delivery, they like to be told in advance. And I think the customers certainly value parcel delivery companies that keep their customers updated and provide an accurate service. If they order a next day service, they want that product next day, and if they order in a time specific slot, they value the fact that you can be there exactly on time.
Is that something that you feel gives you an advantage over some of these newcomers that you say are entering the business? I mean, any Johnny come lately can set up a parcel delivery service without it necessarily being particularly reliable at first.
Yeah, I mean, for the last 2 years, we've put a real emphasis on improving customer service at Yodel. We have in-house surveys of around 100,000 of people that receive a Yodel parcel every week, and we believe we have accurate data on that. Externally, we use services such as Trustpilot to see how customers rate our service. We're now 4.6 out of 5, which is a really excellent score for parcel delivery. And so we believe we've made real progress. One of the reasons that we've made that progress is that we've made significant investment in the training of our drivers on the doorstep so that the experience as they hand over the parcel is as good as it can be. And of course, through the pandemic, more and more people have been at home and they've had first-hand experience of those improvements that we've put in place over the last couple of years.
All right, Mike, we have to leave it there. Appreciate you joining me this morning. Thank you.
Thank you.
Well, time now for our regular look at the business pages of this morning's newspapers. And the Daily Telegraph leads its business section with an exclusive, and a very good story it is too. BT is in talks with a number of potential buyers, including Amazon, Disney and others, over the sale of a stake in its BT Sport division. The Telegraph says the investment bank Lazard has been appointed to advise on a partial sale of BT Sport, and I can tell you BT has, in the last hour and a half, confirmed that story. Telegraph also reporting on a warning from the EU's key risk watchdog about a wave of corporate bankruptcies as government support schemes are wound up. Financial Times leads its companies and markets section with news that a former unit of Airbus was yesterday fined £28 million after admitting to corruption in relation to a contract to supply services to the Saudi military. The FT also reporting on a big vote by shareholders in the London Stock Exchange yesterday against a bumper pay rise for its chief executive. Meanwhile, The Times leads its business pages with comments yesterday from GlaxoSmithKline's chief executive, Dame Emma Walmsley, in which she said she hopes to remain at the helm after the company's planned demerger later this year. The Times also highlights yesterday's vote by partners in Mishcon de Reya, one of the UK's most prestigious law firms, to float on the stock market. Well, rejoining me to talk about some of these stories is Joe Sternberg from the Wall Street Journal. Joe, welcome back. I mean, this Telegraph story is quite astonishing, isn't it, that BT Sport have put the sport business up for sale?
Yeah, and I think that there are two really interesting dimensions to this. I mean, one is the sport angle on this, because, I mean, this is, of course, a big thing for a lot of entertainment companies around the world. I mean, sport is very important for a lot of these companies, partly because it's still something that people have to watch live as it's unfolding. It's, it's sort of harder to do in kind of the stream whenever you feel like it setting. So I think that, in terms of advertising business, it's very important for that. But then there's also this interesting BT angle to this, because, of course, the other thing that they could be doing with whatever capital they would raise from this deal is investing in the broadband network in the UK. And it is kind of reassuring that a year into a pandemic, when we've all been working from home and putting unprecedented new demands on the national broadband network, that we would see that kind of investment.
Absolutely. Now, before Biden spoke last night, we obviously got the latest policy decision from the Federal Reserve. Very, very dovish statement indeed. Do you think that Jay Powell, the chairman, is basically trying to keep on side with Biden so he gets reappointed next year?
Well, I think that there is probably part of that politically, but then, I mean, there's also this broader trend that you've seen of closer relationship between the Federal Reserve and the Treasury in the U.S. Certainly with a former Fed chairwoman, Janet Yellen, now being the Treasury Secretary. And, I think that what's interesting to me about this dovish tilt from the Fed, even as the economy is recovering very strongly and inflation is ticking up, is that it accentuates the importance of low interest rates for financing so many of Biden's spending plans. I think that no one's going to want to talk about monetizing the debt, but there will presumably have to be an element of that, especially if the tax increases don't materialize in the expected levels.
Joe, I read a very entertaining op-ed in your paper, The Journal, this morning by Karl Rove, who's not Karl Rove, it was Ted Cruz. He's obviously a bit ticked off at what he sees as a bit of wokery among US CEOs right now.
And what's really interesting about that story is the fact that, there's always been this assumption that Republicans were on the side of business and that business ultimately would be on the side of Republicans. And you've seen a lot of developments that have kind of challenged that. You have some of Ted Cruz's colleagues in the Senate are taking a more hostile tone toward big tech companies over the past couple of years. And now you've had some of these issues where CEOs like Coca-Cola or Delta Airlines have inserted themselves into political debates, particularly surrounding an election law in Georgia, which is really raising the hackles of Republicans. And I think the signals that there's going to be this bigger realignment that seems to be going on in terms of the relationship between business and both political parties in the U.S. right now.
All right, Joe, we have to leave it there. Good to see you again. Thanks very much for joining me today.
Thanks.
Now, the slogan is crafted for cats and developed for dogs. The UK's first sustainable pet food brand launched this week, replacing meat with what it calls a delicious blend of sweet potato, pulses, fruit and herbs. And wait for it, insects, which contain as much protein as fillet steak. Well, joining me now is the founder of Aardvark Pet Food, Hugo Walters. Hugo, welcome to you. I thought that cats in particular can't have a vegetarian diet. Presumably they've got to have some protein in all of this.
Exactly. So this was the big issue at the start when I've got Coco and Bella, my two cats. And so I realised I was looking for sustainable pet food for them. I'm really struggling to find anything on the market. And the more I looked into it, the more I realised that, the reason we haven't seen any sort of real progress in terms of sustainable food. And on the human side, we've seen so much in terms of alternative meats, in terms of plant-based eating. So I looked into what we could actually do and realised insect-based pet food was the sort of way forward for sustainable pet food. Now, the crucial thing here is insect protein contains the essential amino acids. It's very high in protein. It's hyperallergenic. So these things make it perfect for dogs and cats, which, as you say, a cat is a carnivore. So it can't survive or thrive on a plant-based diet. And you're going to struggle to find any vet who endorses a plant-based diet for a cat.
How easy is it to obtain this insect protein?
So, if you go back to actually 2011, so about 10 years ago, there was a complete lack of essentially insect farming, particularly in Europe. So we use an insect called the black soldier fly, and this has really developed over the last 10 years. The industry has really exploded. The sort of biggest farms are Protex, Next Protein, we work with them, and they farm the insects vertically. So it's far better in terms of the environment. We use about 2% of the land area, 4% of the water, and we farm them on fruit and vegetable waste, which would have previously gone to waste, is now fed to the insects. And so that's how they grow. But it's a developing industry. We've seen a huge amount of investment probably in the last 2 to 3 years into these big farms, and because they need to do it on scale to be able to start feeding pets, to move into, say, fish feed, which is another big industry where insect-based eating is taken off.
And what's the dog called? And does he like it, or she?
So this is Roger, yeah. So Roger's a Frenchie. He's a puppy. So most of his life, actually, let's see if we can get him to sit down and get him on the camera. Roger, what's up? So most of Roger's life has actually been fed aardvark. So we found, in terms of humans, you might have the yuck factor, but in terms of insect protein for dogs and cats, it works very, very well. And we combine, so we create a biscuit, and we combine it with sweet potato, blueberries and seaweed. So I think a lot of people expect they're going to be getting crickets and whole crickets in their pet food. They're not. They're getting a kibble, so it's a dry biscuit. It's combined with these other ingredients, which makes it taste really good. They've all got health benefits, meets all their protein requirements. So that's really what makes it taste good.
Yeah. Now, a lot of people may not realise this, but the pet food market is absolutely dominated by what you might call big food, the likes of General Mills and Mars and Nestle. Do you worry that they might start doing something like this?
I think they're looking to move into the space at the moment. I'm quite proud of the fact we're the first UK company to launch an insect-based dog and cat food. I know Nestle, Mars, they're starting to bring out insect-based pet food, and they're going that way. I think the industry is going to move towards that. But I think being a startup, one advantage there is we're relatively small, so we can work with some amazing vets and nutritionists, but at the same time, we can scale pretty rapidly. We can move at a quicker rate than some of these larger players, where they're slightly slowed down in terms of R&D, in terms of just the size of the business. But I'm confident in those terms that we can sort of scale. But at the same time, as you say, I think we're going to see Mars, Nestle, and Nestle have launched a range actually in Switzerland, which is typically what they do. So when they first launch a product range, they launch it in Switzerland, test it for a while, and then move it out to Europe. So I think we're going to see insect-based pet food being moved across Europe.
Very briefly, Hugo, I mean, the origins of the pet food industry were the cat meat man in Victorian times who'd sort of wander around giving out food that was unfit for human consumption to animals. I mean, surely that would be the most sustainable way of doing pet food, wouldn't it?
Well, we've actually seen an explosion in terms of the premium industry in the last 10 years. So, as you sort of mentioned, back in the day, we had a huge amount of different meats going in, and they were largely offcuts. But what you're actually having now is essentially cattle, say chicken, being slaughtered specifically for dogs and cats. So the industry's really changed in those terms as consumers have looked for better quality meats. So that's why we then say insect protein is a better solution. But I mean, the facts and figures are extraordinary. It's about, of course, the environmental damage associated with the meat industry.
We're out of time. Good to talk to you. Thanks.